Hello everyone, this video is to provide a quick overview of Chapter 19, Corporate Formation, Acquisition, and Liquidation. There are three big topics in this chapter: corporate formation, liquidation, and acquisition. The focus for us is formation and liquidation, and the acquisition and the reorg. This is just for your own reading. This will not be covered in depth in this chapter, and for you just read the text, understand the definition, and there will be no calculation or homework on this portion. And for the formation, let's think about the underlying transaction. The underlying transaction, the corporate formation, is the shareholder exchange properties for corporation stock. So in that case, the corporation received the property from the shareholders. This property can be in the form of cash or land or building or those non-cash property. Therefore, from a corporation's perspective, they need to establish the basis in the property received. From the shareholders' perspective, the first they have to determine whether there be any gain or loss to be recognized on the transfer of the property from the shareholder to the corporation. Um, the other thing is they have to establish the basis in the corporation stock, because in this particular transaction, they receive the corporation stock in return for those properties. And on the other hand, the liquidation is the opposite transaction of the formation. So in the final stage of the corporation distributes the property to the shareholders in exchange for the stock. And after all said is done, then the shareholder and the corporation relationship cease to exist, and the stock becomes, worthless. Really, it's a final liquidation distribution. So, from the shareholder's perspective, the shareholder, in this case, they're going to recognize any gain or loss. They need to figure out whether there's any gain or loss recognized, because they just basically distribute the stock back to the corporation. So in that case, they had to determine how much value they received in this final distribution and how much is the stock basis, and figure out any gain or loss on the disposition of the stock ownership in the corporation. And on the other hand, the shareholder also received properties in this final liquidation. Then they also need to establish the basis in the property received. From a corporation's perspective, they just transfer a whole bunch of property to the shareholders in the final liquidation. Again, in that case, they need to determine whether there's any gain or loss recognized for the property they just transferred. So again, the common theme of this chapter, as you see here, is regarding gain-loss recognition, gain-loss deferral. If it's not recognized, it will be deferred. And when the gain-loss will be recognized, when the gain-loss will be deferred, and how that could affect the basis. So all those points are intricately linked. So when you read the chapter, just keep those in mind when you get to the gain loss recognition and the basis in the property. And really understand is which party we're talking about. Is it corporation or is it shareholder? So again, the focus of this chapter is on the formation and the liquidation, gain loss recognition, and the basis. Okay, now let's get to some of the specific topics in the corporate formation section. The section 351 tax deferral is covered in detail. So, the gist of the section 351 is basically saying the transfer of property to the corporation in exchange for stock, generally speaking, will qualify for the tax deferral treatment as long as the transfer of the property is in control of the corporation immediately after the transfer. So the exception does apply when there's boot received. So in this case, if there's any boot received in this transfer, then there could be a gain recognition. The gain will be limited to the lesser of the fair market value of the boot or the gain realized. So in the 351 transaction, the shareholders' tax basis of the stock is calculated as below. This calculation actually apply to all shareholders' tax basis of the stock. So whenever you are calculating the shareholders' tax basis of the stock, you have to consider all those factors: the cash contributed, tax basis of other property contributed, and a gain recognized on the transfer, minus the fair market value of the boot received, and minus the liability assumed by the corporation on the property contributed. If there's no boot received, you can ignore this piece. And more importantly is you want to make sure we have a special note here: assumption of a liability is generally not treated as boot. And on the other hand, the corporation's tax basis in each asset received in a Section 351 transaction is equal to the tax basis of the asset contributed by the shareholder. In other words, is the shareholder's adjusted tax basis and plus any gain recognized by the shareholder on the transfer of the asset to the corporation, if there's any. If there's no gain, then the tax basis of the base asset received by the corporation will be equal to the tax basis of the asset contributed by the shareholder. Now let's get to the tax consequences to the shareholder in a complete liquidation. Generally speaking, the corporate shareholders owning 80% or more of the stock of the liquidating corporation does not recognize any gain or loss on the receipt of the liquidating distribution. So in a sense, what it's saying is, in a corporate shareholder context, in this case, if the subsidiary liquidate itself into the parent corporation, there's no gain or loss on the receipt of the liquidating distribution. So there's no gain or loss. The non-corporate shareholders receiving the liquidating distribution have a taxable transaction. So generally speaking, non-corporate shareholders receiving the liquidating distribution does have a taxable transaction. So the shareholders will treat the property received as a full payment in exchange for the stock transfer. The non-corporate shareholder computes the gain or loss, capital gain or loss, by subtracting the stock's tax basis from the money and the fair market value of the property received in return. And a shareholder's tax basis in the property received equals the property's fair market value. And this will be adjusted by the debt assumed by the shareholder. And the fair market value of the property cannot be less than the debt assumed by the shareholder. The disposition of Section 1244 small business stock will qualify for ordinary loss treatment. This is something you have seen in the individual taxation investment chapter. In this case, in the corporate formation setting, what we need to know is if original shareholder of a small corporation, if it basically there's less than 1 million capitalization contributed, then the stock will be treated as Section 1244 small business stock. And also the corporation must meet active trade or business requirements for 5 years before the stock meets the Section 1244 requirements. So this is just something just in the context of the corporation formation, we just want to be aware of the rules, especially from the shareholders' perspective. Next, we're going to cover the tax consequences to the liquidating corporation in a complete liquidation. So the liquidating distribution are generally taxable transactions. So from the liquidating corporation perspective, they're going to recognize all gains and certain losses on taxable distribution of property to the shareholders. And there is exception. So in this case, is the liquidating corporation does not recognize loss if the property is distributed to a related party and the distribution is non-pro rata and the asset distributed is a disqualified property. The only exception is the parent subsidiary liquidation. The liquidating corporation does not recognize gain or loss on the distribution of the property to a corporate shareholder with 80% or more ownership. Any liquidation related expenses will be deductible by the liquidating corporation on its final form 1120. And deferred or capitalized expenditures such as organizational expenditure are also deductible on the final tax return. This is something is for your information, just like I mentioned in earlier. The taxable and non-tax, from an acquisition perspective, we need to distinguish the asset purchase versus stock purchase. We need to distinguish taxable acquisition versus tax deferred reorg. This is for your information. Uh, you just need to read the definition of type A, B, C, D, E, and F and understand what those reorg is about. But we're not going to get into the specifics of these transactions. Finally, I want to quickly introduce the Chapter 19 homework template. So we only have three homework in the simulation. Uh, the Chapter 1938 is related to corporation formation problem, and 1963 is a liquidation distribution, and 1965 is also a liquidation distribution, but this is a subsidiary completely liquidate itself into the parent, so will qualify for the tax-free treatment. So on the back of the worksheet, I have built this template to help you solve the problem in chapters 4, 38, 63, 65. So each of the tab, once you kind of walk through the template, you should be able to see some connection between corporate formation and 38. Liquidation distribution A ties to the problem 63, and liquidation distribution B is ties to the problem 65. So while we're kind of moving along with the course, I will expect you to come up with the hints and complete the hints and understand what type of rules you have to draw upon to solve these problems. I will say go back to the chapter notes will be a good place to go. And if it's a corporate formation, you can find the tax deferred transfers of property to a corporation section. You can copy the relevant section to the hints to help you uh, solve the problems. And reflection needs to be completed as well. So really what I'm looking for is a completed worksheet. Covers all 5 sections, the facts, questions, and hints, and reflections, and a problem solving. So I already finished some part of it, so I will rely on you to complete the parts which are not finished for chapter 19, 38, 63, and 65. Thank you so much for listening, and you have a great day.